Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, more than $1 trillion has vanished from the global cryptocurrency market over the past 6 weeks, as renewed anxiety over elevated tech valuations and uncertainty surrounding the US Federal Reserve's next policy moves has triggered a sharp sell-off in speculative assets. According to CoinGecko, the combined market capitalization of more than 18,000 digital coins has fallen 25%, peaking on the 6th of October, erasing roughly $1.2 trillion in value. Bitcoin, the world's largest cryptocurrency, has dropped about 28% over the same period to a little over $90,000, hovering near its lowest level since April and leaving it broadly flat for the year. Analysts say accelerating losses and highly leveraged trading positions have amplified the downturn, setting off a feedback loop of forced liquidations and falling prices. The slump marks a reversal for a sector that only months ago was supported by US President Donald Trump's pledge to make the US a so-called Bitcoin superpower, and his appointment of a crypto-friendly SEC chair. Quote, despite all the institutional adoption and positive regulatory momentum, crypto market gains have now been wiped out on the year, end quote, said a crypto analyst at Cantor Fitzgerald. Fresh doubts about the potential Fed rate cut at the December meeting have deepened the malaise. Lower borrowing costs typically enhance the appeal of speculative assets by reducing returns on safe short-term US government debt. The diminishing odds of a December cut after the Fed's 0.5 percentage point reduction earlier this year have also weighed on equities, pushing the S&P 500 about 3.5% below its record close on the 28th of October. But the sharpest blow came on the 10th of October, when US President Donald Trump's threat to impose, quote, massive tariffs, end quote, on China triggered an unprecedented $20 billion liquidation of leveraged crypto positions, the largest single-day decline on record. The episode, now dubbed 1010 by traders, has left a lasting imprint. Quote, this is not a collapse, it's an extended aftershock of October's liquidation event, end quote, said David Namdar, chief executive of CEA Industries, speaking to UK-based The Financial Times. Others have been less optimistic, calling Bitcoin a mega bubble, with this $1 trillion hit representing the beginning of the pop. Whichever side is correct, only time will tell ultimately, the fallout so far has been broad. 6 of the largest 20 cryptocurrencies have slid more than 40% this year, while digital asset investment products, including Bitcoin ETFs, saw $2 billion in outflows last week alone, the single biggest since February. A Goldman Sachs index of unprofitable tech firms, favored by retail traders, has shed 19% since mid-October. Still, some signs of stabilization emerged on yesterday, as US stock futures and Bitcoin paired losses. Quote, we expect Bitcoin to see more volatility in the coming months, end quote, said Nick Ruck of LVRG Research in a note today, adding, quote, but long-term buyers are already viewing this drop as an opportunity, end quote. Next up, we move to Europe. Poland is grappling with what Prime Minister Donald Tusk has called the most serious act of sabotage on its soil since Russia's full-scale invasion of Ukraine in 2022. Yet the attempted attack on a critical rail corridor also comes at a moment when Poland is emerging as one of Europe's most dynamic economic powers, a juxtaposition that underscores both the risks and resilience shaping the country's trajectory. Speaking in Parliament on yesterday, local time, Tusk said 2 Ukrainian nationals working for Russian intelligence were responsible for an explosion that damaged tracks on the Warsaw-Dorohsk rail line over the weekend. The route is essential for passenger travel and the daily flow of Western military aid into Ukraine. Quote, a certain line has been crossed, end quote, he warned, noting the incident, quote, could have resulted in a serious disaster with casualties. End quote. The suspects allegedly fled to Belarus after the attack, prompting Warsaw to seek cooperation from both Minsk and Moscow. Polish officials were quick to frame the sabotage within a broader pattern of Kremlin-directed hybrid warfare. A spokesman for the Polish intelligence coordinator said evidence pointed clearly to Russian services, The Kremlin dismissed the accusations, accusing Poland of Russophobia. The incident follows a September drone incursion that triggered a deployment of fighter jets, a sign of escalating threats facing a NATO frontline state that borders both Ukraine and Belarus. Poland has raised its alert levels across railway infrastructure as investigators secure evidence. Yet these security anxieties stand in sharp contrast to Poland's economic momentum, a good thing considering Poland is radically increasing its defense spending as it sees Russia's moves as an existential threat. Since 2016, Poland's GDP has expanded 93%, far outpacing, for example, the UK and most EU peers. It is projected to grow more than 3% annually through 2027, twice the EU average. Household consumption has soared 125% since Brexit. The Polish currency is the best performing emerging market currency since Russia's invasion, and Polish government bonds have delivered the strongest returns in Europe. The stock market is up nearly 50% this year, with financials leading the surge. Analysts say Poland's size, strong domestic consumption, low unemployment, and converging income levels give it resilience even amid geopolitical shocks. It also now leads NATO in defense spending as a share of GDP. For Europe, Poland's response to the latest sabotage attempt, firm coordinated with allies and underpinned by economic confidence, signals that one of Europe's rising powers intends to remain on the front line, both militarily and economically. Now, next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of Market Update, it's a huge help if you can hit that like button. And if you'd like to continue to be on top of updates like today's, through grounded and sober analysis, consider subscribing to Market Update. Hit the bell notification icon, and you will be. And finally, for today, we move to Asia. An early bid to cool tensions between China and Japan appears to have fallen flat, raising the risk that the diplomatic dispute will drag on and strain the two countries' already fragile economic ties. This is a space we've been following very closely on my other channel, China Update. After meeting Japanese diplomat Masaki Kanai in Beijing on Tuesday, Liu Jinsong, Director General of the Chinese Foreign Ministry's Asian Affairs Department, publicly expressed, quote, dissatisfaction, end quote, with the outcome, according to China's state-run The Paper. Clear signal that Beijing sees no immediate off-ramp. Relations have deteriorated sharply since Prime Minister Sanae Takaichi became the first Japanese leader in decades to openly link a potential Taiwan Strait conflict to the deployment of Japanese troops, though commentators do point out that this has been the official position of the Japanese for years and that previous leaders have indirectly made this point. Her comments triggered swift retaliation from Beijing, which warned of further countermeasures. Tokyo, for its part, insisted that Takaichi reaffirmed Japan's long-standing position on Taiwan and lodged a complaint over, quote, extremely inappropriate statements, end quote, by Xue Jian, China's consul general in Osaka, who threatened to cut off Takaichi's head in a since-deleted post. Japan has demanded disciplinary action. The diplomatic rancor is already spilling into economic channels. China has advised its citizens to avoid traveling to Japan, prompting several state-owned travel agencies to cancel group tours. State firms have also warned employees against visiting Japan, heightening concerns about disruptions to tourism and business exchanges. One air travel analyst, Li Hanming, said departure data suggested about 500,000 flight tickets to Japan had been cancelled between the 15th and 17th of November. Japanese markets reacted swiftly. Tourism and retail stocks tumbled before partially recovering, while the Nikkei 225 plunged 3.2%, its steepest fall since April. Yields on Japan's 40-year government bonds jumped to the highest level since the security debuted in 2007. Quote, Beijing is clearly signaling that it is not ready to let the fire die out, end quote, said Jeremy Chan, senior analyst at Eurasia Group. China continues to demand a full retraction from Takaichi, a so-called maximalist position analysts say is politically impossible for Tokyo, leaving few avenues for de-escalation. Symbolism added further intrigue. Chinese state media highlighted Liu's tunic-style suit, likening it to the attire worn during the 1919 May 4th move, a nationalist and arguably ethno-nationalist uprising against the transfer of what they considered Chinese territory to Japan. Some scholars interpreted Japan's decision to send a mid-level diplomat as a sign of insufficient seriousness. Market sentiment is further soured amid worries about Takaichi's fiscal package, lofty tech valuations, and broader geopolitical uncertainty. Analysts warn that despite hopes for a rebound, any disappointment, including from Nvidia's upcoming earnings, would deepen the sell-off. With senior diplomats set to meet again in Beijing this week, both governments face rising pressure to stabilize the relationship before economic fallout, something that both the economically vulnerable nations could do without, worsens. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I hope to see you for the next episode, which will either be tomorrow or on Friday.